the risk is more the other way. The biggest potential bid for gold is at some point, all these ETF flows will flip to an inflows. And I think that was going to take one key fact and a key flip, I should say, and that is the stalwart U.S. stock market stop going up. I mean, it's stealing flows, and Bitcoin's is kind of leading the way. And at the same time, you're getting 5% U.S. T-bills. I mean, the safest assets on the planet. That ain't good for gold.
Right.
At some point, that's going to change, but that's why I'm still bullish gold. But the key thing I like to say is it's kind of hard to be.
China's central bank announced a significant gold purchase of 10 tons in January, which has increased its total gold reserves to 2,245 tons. This purchase marks a continuation of the People's Bank of China regularly announcing gold reserve additions since November 2022, with 297 tons reported over these 15 months. MikeMcGlone, a senior commodity strategist at Bloomberg Intelligence, suggests that China's geopolitical shifts towards countries like Iran, North Korea, and Russia, alongside its consistent gold purchases, could have significant implications for the gold market. He implies that these actions may reflect a broader strategic shift by China towards tangible assets like gold. In a notable trend, gold ETFs have experienced significant outflows since introducing 10-spot Bitcoin ETFs on January 11th. The two largest gold ETFs, SPDR Gold Shares, GLD, and iShares Gold Trust, IAU, with AUMs of $58 billion and $26 billion, respectively, at the beginning of 2024, have seen net outflows. McGlone attributes the outflow from gold and silver ETFs to a broader movement towards intangible assets like digital assets, particularly Bitcoin. He suggests that the most substantial potential demand for gold might come from a market reversal or a shift in investor sentiment away from digital assets. Conversely, Robert Kiyosaki, a well-known investor, predicted a decline in the price of gold amidst the influx of spot Bitcoin ETF inflows. His prediction anticipated gold prices dropping to $1,200 while Bitcoin and silver surged. Kiyosaki's outlook aligns with the data, showing stronger inflows into spot Bitcoin ETFs than gold ETFs. Join us as we explore the insights shared by MikeMcGlone. Stay updated by subscribing to our channel and activating notifications. Thank you.
Silver's going more the direction of industrial metals. It's more of industrial metals now. It's been demonetized for centuries and it's accelerating. But here's what's in common. Just as we were clicking in to do this recording, I double-checked the total change in gold ETF holdings and silver ETF holdings over the past year. They're both down about 10%. Never happened, and both gold's up about 12% and silver's up about 9%.
Right.
So it's never happened. And since gold ETFs really started trading 20 years ago, 2004. So what's going on? And I see I'm more worried that silver is going to continue to track lower with industrial metals and crude oil. I'm bearish on both, particularly because I'm bearish on China. Now just think of how that pendulum has swung completely last year, where we were supposed to China reopening is supposed to come out of it, and it's all tilting towards, they have to completely depend on fiscal and monetary stimulus. But I have to point out facts, and there's significant outflows in these ETFs, and there's significant inflows in the intangible new digital gold, and that's Bitcoin. And how much of that is one for the other, but you have to point out the facts. And the thing I've been saying for years is you can't hold gold anymore without Bitcoin in that space. And it's just, we're in one of those spaces right now is, if you see what's happening with, U.S. debt to GDP and things like that, if it wasn't for Bitcoin, which it unfortunately shouldn't, I don't like to use hypotheticals, but it's just showing how the world is going to intangible assets, and this new digital gold is just sucking flows. The latest World Gold Council report was they used the word colossal for the last 2 years. China's number one. And so look at what's happening in the macroeconomic world. We have this significant tilt where China, with respect for China and its history and its people and its future, one leader has tilted toward the bad guys of the world with unlimited friendship. He's tilted toward Iran, North Korea, and Russia. One leader. And I think most Chinese citizens I think history is going to look back at that and say, to use the American vernacular, dude, what were you thinking? That's what's happening. It's factual, and the rest of the world who used to import from China, the number one importer in this country is Walmart, has to get out in any way they can. And you're seeing those reverberations. But China is also tilting, and the old bad guys are tilting towards the old guard of gold. I mean, they're the biggest. People's Bank of China is the biggest buyer on the planet at a colossal pace, and they have the ability to print fiat currency and buy gold with it, and they're doing it. So to me, that's the significant. And these wars. I mean, so the key thing, I just published my metals outlook. I think the key thing that's a risk for gold right now is some detente in the unlimited friendship. Say Mr. Z were to be deposed or to pull back and say, you know, it's kind of a mistake. It's not working out. Sorry, Vlad, but pick up on the phone. I can just see the conversation, dude, it's not working. And it's not. So that's one of the key risks for gold. But I think the risk is more the other way. The biggest potential bid for gold is at some point, all these ETF flows will flip to an inflows. And I think that was going to take one key fact and a key flip, I should say, and that is the stalwart U.S. stock market stopped going up. I mean, it's stealing flows, and Bitcoin's is kind of leading the way. And at the same time, you're getting 5% U.S. T-bills. I mean, the safest assets on the planet. That ain't good for gold.
Right.
At some point, that's going to change, but that's why I'm still bullish gold. But the key thing I like to say is it's kind of hard to be. I think people who are completely biased towards gold and don't have some Bitcoin in that space are taking a necessary risk with advancing technology moving rapidly.
MikeMcGlone highlights that despite the current speculative frenzy, central banks might not be inclined to ease monetary policy until speculative excesses are corrected within the market. According to CME Group data, futures traders have assigned a probability of nearly 70% for a Federal Reserve interest rate cut by June 12th. This probability increases to over 85% by the end of July, indicating that the potential for a summer rate cut is strongly factored into traders' expectations. The Fed's decision-making depends on whether inflation, which has significantly decreased since its multi-decade high in 2022, continues to approach the Fed's long-term target of 2%. McGlone expresses concerns regarding speculative excesses in the stock market, particularly with the S&P 500 already showing a 7% total return for the year. According to Dow Jones Market, the S&P 500 has posted gains in 16 out of 18 weeks, a feat not seen since April 1971. The index recorded a weekly gain of 0.9%. Young-Yu Ma, Chief Investment Officer at BMO Wealth Management, suggests that after the U.S. stock market's significant increase over the past 4 months, investors are anticipating a second leg of the rally. Let's get back to the interview.
Well, so there's been consolidation in banks, notably in the U.S. for decades, at least a decade. And J.P. Morgan's a great black hole. I remember having a good friend at Bear Stearns, and that's now part of J.P. Morgan, but that was another story.
Right.
But the fact is, I like what Jamie Dimon said. The commercial real estate will be fine as long as there's not a recession. But that's where I get that tilt. The stock market absolutely has to go up. I've never seen it this risky in my lifetime. Inverted yield curve, leading indicators, China in decline, Japan in recession, UK in recession, Germany in recession, most of Europe in recession. The average of PPIs for the U.S., the top 4 horsemen of the world, I think I mentioned this last time, U.S., Japan, Germany, and China, is minus 3%. That's severe deflationary forces from the high beta leading indicator. So banks, in a contraction lending, how can you expect not to have economic problems? That's why I view it as that to me is where that's showing up is a contraction lending. You see diesel demand in this country is the same as 2017. We have not had that long period of stagnation ever in our database back to the 90s. Unleaded gas demand is declining. Paperboard box demand is declining. All various recessionary trajectories. And the only thing that's keeping us going here is there some of the data is still strong, as obviously is the stock market. And that should be the leading indicator. That's why I look at it. It is so risky. And then I look at S&P 5 E-minis. There's a gap down almost 10% below from December when we had that manic rally. So I look at this as so we're recording on February 27th. It's been a great year for stocks already. The total return for S&P 500 is almost 7%. That's getting a little speculative excess. And here's the key thing I want to end with, Ivan. One thing that's really hit me lately is the high price cure is kicking in the stock market. So it was one of the key things I started pointing out in commodities about 2 years ago. It's something you learn from a farm background, which I have, used to own a farm, is farmers always say it, and commodities are in the middle of the high price cure, the back end of that scale right now. The prices went up too much, so technology kicks in, supply and demand kicks in, and prices go down. They're still heading lower, with the exception of one, which I think is heading towards a low price cure now, and that's natural gas. But now the stock market's in that phase. There is no reason with the S&P 500 and massive speculation in the stock markets and in cryptos this year going up that much, and the Fed's inflation targets, core PCE, core CPI above their targets to ease. And every time the stock market goes up, you see those easing expectations taking out. And most people will tell you the number one thing for equities is liquidity.
Right.
And easing. And so that to me is the problem, that the more it advances, the more there's easing comes out of the market, which means it's the high price cure might kick in equities. And I've been early. I've been wrong. If I was a trader, I would have been stopped out, admitted. And it's maybe why I used to have hair and I don't trade anymore. But as a strategist, you have to point out these facts. So that to
Right.
me is where the macro big picture is coming in. I just look like this speculative frenzy that's kicking in Bitcoin now. It's just a sign that there is no reason at all for central bank easing in this country until you see those speculative exits wrung out of the market. Because here's a key thing I'll end with. The book I read recently was called Capitalism Without Capital. I think McGregor was the author, I don't remember, but all about the difference, the significant difference in intangible assets versus tangible assets. Commodity and gold are tangible assets, but they're really falling by the wayside by intangible assets. And intangible assets, as measured by S&P 500, are rising rapidly. So expect inflation to decline in that environment is very unlikely, i.e. the wealth effect. And Bitcoin's an intangible asset. Gold is a tangible asset. So there's where you have a little bit of a battle.
Despite gold maintaining its price above the crucial $2,000 mark for a fourth consecutive month, gold ETF outflows continue to move into Bitcoin. This has encouraged gold stock shorts, which have seen an increase in activity. This scenario is reminiscent of a similar pattern observed during a notable mining sector bottom in January 2016, coinciding with a tumultuous U.S. election year. Considering the significant gold purchases by China's central bank and the ongoing trend of gold ETF outflows into Bitcoin, what factors do you believe will drive the future performance of both gold and Bitcoin in the coming months? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.